Now let's bring in George Tsilis. He's a senior markets correspondent here. George, we're talking Datadog. Stock's had a decent run, up about 25% so far this year, but nice little upgrade today out of Piper Sandler. What's your take here on Datadog?
Good. There's a few things going on with the company. I mean, you got a couple upgrades. Piper Sandler increases their price target to 115, and UBS also initiated coverage on the company with a $100 price target. I think if you look at Datadog, which is essentially a very pronounced company from the standpoint of growth, and of course data analytics, they've actually been growing their platform as a service-based business, which basically helps IT managers and developers monitor their applications and, of course, make adjustments and modify their applications on a remote basis. So there's an observable cloud element to Datadog's business, not to mention, of course, the secular trends that are going on with artificial intelligence. But interesting enough, if you look at the stock, there was a huge gap in the chart. This goes back to August. I went and looked at the report. If I remember correctly, they actually beat the earnings and sales estimates. Net revenue retention rates were over 120%. It gives you an idea that they're getting more money out of existing customers. New customer growth actually was higher by about 30%, with sales over 40% over the last year. But one of the things that caused the stock to fall about 20% was they actually gave guidance for Q3's revenues, which were slightly lower than Wall Street estimates. And I think now, considering the stock has actually hit the $85 area, which was actually the low back on the earnings day back on the 8th of August, is starting to look interesting, I think, from a technical standpoint. And maybe the guidance that the company provided was a little bit low relative to the estimates, which I think now are starting to rise, and maybe this is why the analysts are upping the stock.
Yeah, George, that was a big gap on their earnings day because they basically came out and lowered their full year guidance. And they talked about, maybe some problems going forward, but the end game, the end market for this product is going to be there. They're going to have demand. They don't have, they have a monstrous negative PE, so they're not exactly profitable yet consistently. But George, this company has recovered a little bit from that big gap down there on their earnings. They've got earnings coming up here. Well, I mean, do we trust this yet, George? Is it safe to get in this?
Well, I can't say if it's safe. I will say this, that, there are times when you see, of course, gaps to the downside and a continuation. I think last week's retest of the low level at 85 from a technical standpoint looks interesting, because if you also look at that level from a technical standpoint now, there's a confluence. There's the 200 period moving average, which is still rising, and it actually hit that level back last Thursday as well. So that, may be a technical support area. The other thing is, I think if you just consider the fundamentals, absent the fact that, yes, they did cut the guidance for fiscal year 23, that's why the stock went down 20%. But nonetheless, the sales growth estimates for the full year next year are still 35%, with EBITDA at 48%. Now, if you look at the forward multiple at around 65 times earnings, that's about 1.5 times EBITDA growth, which one would say, looking at a PEG ratio of 1.5 would be considered fair value. So, lofty PE ratios on an absolute basis, yes, but the company's been growing pretty tremendously. And I think, looking at last couple of weeks with the announcement of Splunk being acquired by Cisco, now that they're not exactly the same kinds of businesses, but I think if you look at the observability features of Datadog's technologies, that's in line with companies like Splunk. So maybe, based upon that acquisition, the multiple maybe justify the trade at these levels. I can't say for sure, but nonetheless, I think the chart looks interesting, because it is maybe a double bottom, hitting that 200-day moving average, again, hitting those lows from the August 8 report.
Yeah, still not profitable on a gap basis at this point.
Correct.
And they're struggling, George, with those the competition from Cisco's App Dynamics and then also New Relic.
Yep.
They're not gaining those $100,000 a year in annual recurring revenue from those bigger clients, because enterprise spend's been coming down a little bit. So maybe some headwinds there. All right, great stuff, George. As always, appreciate it. That's George Tsilis breaking down Datadog after the Piper Sandler upgrade to 115 from 88, put a buy rate or an overweight rating from neutral.